Chapter 11, Property Dispositions, pages 11-14 to 11-20. The topics that I will be covering today are Section 1250 Depreciation, Recapture, or Real Property, Unrecaptured 1250 Gain for Individuals, Characterizing Gains on the Sale of Depreciable Property to Related Persons, Calculating Net Section 1231 Gains or Losses, and finally the Section 1231 Look-Back Rule. First, I'd like to go over a few terms. Section 1250 property is real property subject to cost recovery deductions. Section 291 depreciation recapture is the portion of a corporate taxpayer's gain on real property that is converted from Section 1231 gain to ordinary income. Unrecaptured Section 1250 gain is the type of Section 1231 gain derived from the sale of real estate held by a non-corporate taxpayer for more than 1 year. The gain is taxable at a maximum 25% capital gains rate. Section 1231 assets are depreciable or real property used in a taxpayer's trade or business owned for more than 1 year. The Section 1231 look-back rule is a tax rule requiring taxpayers to treat current year net Section 1231 gains as ordinary income when the taxpayer has deducted a Section 1231 loss as an ordinary loss in the 5 years preceding the current tax year. Non-recaptured net Section 1231 losses is a net Section 1231 loss that is deducted as an ordinary loss in 1 year and has not caused subsequent Section 1231 gain to be taxed as ordinary income. First topic is Section 1250 depreciation recapture or real property. Section 1250 recapture is applied to depreciable real property sold at a gain, such as office buildings and warehouses. The gain recognized as ordinary income is limited to the excess of accelerated depreciation deductions over the amount of deductions available if straight-line depreciation has been implemented. Since Section 1250 recapture is not frequently used because current laws state that real property depreciated must be depreciated using the straight-line method, Section 291 depreciation recapture is applied in place of it. However, Section 291 recapture is applied only to C corporations. For Section 291 recapture, C corporations recapture as ordinary income 20% of the lesser of recognized gains or accumulated depreciation. Let's look at an example. A C corporation sold an office building. The selling price was $200,000 and the purchase price was $95,000. The straight-line depreciation deductions are $10,000. Let's find the character and the amount of the gain on the sale. So first we find the adjusted basis, which is the amount realized less accumulated depreciation, which gives us $85,000. Next we find the gain or loss. We subtract the adjusted basis from the amount realized to get $115,000. Now we need to find the lesser of either the accumulated depreciation or the gain. The accumulated depreciation is $10,000 and is the least amount. Next, we multiply the $10,000 by the 20% 291 recapture to get $2,000 of Section 291 recapture ordinary income. Now we find our Section 231 gain. We subtract the Section 291 recapture of $2,000 from the recognized gain of $115,000 to get our final total of $113,000. Topic 2. Unrecaptured Section 1250 gain for individuals. When individuals sell Section 1250 property at a gain, it is recognized as a Section 1231 gain. We then use the netting process and combine the gain with all Section 1231 gains and losses for the year. So what if the netting process results in a capital gain? Then whatever portion of the gain that qualifies as a depreciation deduction will be taxed at a maximum rate of 25%. The amount taxed at 25% is the lesser of the recognized gain or accumulated depreciation. The remaining amount that doesn't qualify as a depreciation deduction is taxed at 0, 15, or 20%. So let's look at an example. A sole proprietorship sells an office building. The selling price is $200,000, the purchase price is $95,000, and the straight-line depreciation deductions are $10,000. Let's find the character and the amount on the gain of the sale. So again, we find the adjusted basis by subtracting the accumulated depreciation from the initial basis, which gives us $85,000. Then we find the gain or the loss by deducting the adjusted basis from the amount realized, giving us $115,000. So to find the unrecaptured Section 1250 gain, we would find the lesser of either the accumulated depreciation or the gain or the loss on the sale. The one with the least amount is the accumulated depreciation. So then we subtract the unrecaptured Section 1250 gain from the gain or loss recognized to get the remaining Section 1231 gain. Finally, we add together both recognized gains, the unrecaptured Section 1250 gain and the remaining Section 1231 gain, to get our total Section 1231 gain of $115,000. Topic 3. Characterizing gains on the sale of depreciable property to related persons. So here we're looking at the Section 1239 provision. Section 1239 provision states that sales of property to related persons are categorized as depreciable property for the buyer. The seller then recognizes all the gain as ordinary income. The seller recognizes ordinary income for depreciation deductions that the buyer will receive in the future. So who's considered a related person under Section 1239 provision? An individual, the individual's controlled corporation or partnership, a taxpayer, and any trust in which the taxpayer or their spouse are beneficiaries. So here we have an example chart of the characterization of recognized gains and losses on the sales of assets used in a business. Topic 4. Calculating net Section 1231 gains or losses. The Section 1231 property is real or depreciable business property held for more than 1 year. The netting process for Section 1231 gains and losses is calculated annually. The losses offset the gains and then offset unrecaptured Section 1250 gains. For the netting process of Section 1231 gains, when there are gains recognized, after the Section 1231 look-back rule is applied, a long-term capital gain is recorded and taxed at a maximum 25%. However, if the netting process results in a net loss, then it is recognized as an ordinary loss and it offsets ordinary income. So what are the steps in the netting process? Step 1. Apply depreciation recapture and Section 1239 rules to Section 1231 assets sold at a gain. 2. Net the Section 1231 losses and gains. Section 1231 losses offset the Section 1231 gains and then offset Section 1250 gains. The losses offset ordinary income. Step 3. Apply the Section 1231 look-back rule to the gains. Any gain remaining is characterized as a long-term capital gain. Topic 5. Section 1231 look-back rule. This rule is a non-depreciation recapture. It affects the character of a gain, deciding whether a gain can be considered ordinary income or a capital gain. The gain is characterized as ordinary to the extent it doesn't exceed the amount of non-recaptured net Section 1231 losses in the 5 years prior. So what if the gain is greater than the non-recaptured net Section 1231 loss for the 5 years prior? Well, then the taxpayer performs the same test for each year, year 4, 3, 2, and 1, until the gain is not greater than the net Section 1231 loss for the 5 years prior. So let's look at an example. Suppose your business recognized an $8,000 net Section 1231 gain in year 1. In the current year, year 5, you recognize the net Section 1231 gain of $15,000. What is the maximum amount and character of the gain recognized? So the amount of $8,000 would be categorized as ordinary income and would be recognized that way. The remaining amount, which would be the amount recognized in year 5, minus the amount recognized as net Section 1231 gain in year 1, and that would be $7,000. And this would be characterized as a long-term capital gain. In conclusion, this chapter was interesting as it touched on the netting process for Section 1231 gains, which was covered in other chapters. I also learned about the characterization of gains and losses and how each characterization affects taxpayers and business owners.